Hi everyone, welcome to this tip around property and incorporating property into a cash flow, and equally some of the tools and calculators we've built that help you with mortgage calculations and rental yield calculations and stamp duty as well. Now, why would you want to include property within a cash flow? For the most part, you probably wouldn't. For the most part, you just want to focus on someone's liquid pots, a bit like this. My client's got 5 liquid pots sloshing around, providing for my client post retirement, and then they run out of money by the time they're in their mid 90s, and then they're 200,000 in the red by the time they're 100. But therein lies the problem. Yeah, they're not 207,000 in the red because they've got a very large, or likely to have a very large, illiquid pot sitting behind this that could easily cover that shortfall with some sort of equity release scheme. And clearly, when you show your clients this image, or most people this image, they're not really going to focus on this really great news story over here. They're going to be focused on this tiny bit of red over here. So that's why sometimes it's quite nice to include the property, just to remind the client and anchor their focus back to their overall wealth, not just their liquid pots, but their illiquid pots as well. So this cash flow image is exactly the same as what you just looked at, but now I've just added the house on top of it. So I've got a client's home. I've called the savings pot home, starts at 500,000, grows just over inflation. And then by the time they do run out of those liquid pots, they've got their illiquid pot, which is property that will be worth well over 800,000 by then. And by the time they are 200,000 in the red, well, their house is worth nearly 900,000. So it's just quite a nice way, again, of reinforcing that idea that they do have other assets that they could then rely on for income purposes post running out of those liquid assets. How do you add that to a cash flow? Well, it's quite simple. Under the savings pots on the left-hand side, you can just simply hit add savings pots. I called mine home. What do I want the starting value to be? 500,000 was mine. Example, linear rate. What do I want it to grow at? I assumed 4% a year based on historical averages, 1.5% real return because my inflation's running at 2.5. If you just wanted it running, of course, at inflation and just retain its real value, you could, of course, just put 2.5% in there and it would just stay at 500,000. But when you're looking at that cash flow image, you possibly were asking yourself, well, why is it not taking from the property? Because the property was locked. And that's the option here. Lock this pot from automatically covering all income, an income shortfall, because I can't sell parts of my property. I don't want the cash flow when it suddenly goes 11,000 into the red to take 11,000 out of the house. I can't do that. I can't, as I said, I can't sell the odd brick here and there. So I can lock the pot from any shortfall from today up until the 100th year of the forecast. So that when I go to my cash flow model, as I've explained, it's not taking from the pot. It is still going into the red, and then you've just got the house over the top of it. Incidentally, if I wanted the house to be at the bottom as opposed to the top, it would still be locked. I don't personally like it that way. I like it at the top with all the liquid assets sloshing around underneath, and then the home at the top. But under the savings pots, just each to their own. If you would prefer it at the bottom as opposed to the top, you can just simply drag the home to the top, and it will then just change the order of the cash flow image. Um, so hopefully that's useful. Hopefully that's kind of explained the logic and how to include a house into a cash flow and why do you want to do that. Now, if I click on the tools tab at the very top here, when you've selected a client, when you click on tools, you've got a number of these financial planning calculators as well that sit in the background for you for them to help on various different cases you're working on. And the 3 related to property, you've got stamp duty calculator that helps calculate the stamp duty. You've got mortgage and equity release calculator that helps calculate the mortgage or equity release contract you've got, and then the rental yield calculator that will help calculate the asset growth and rental yield of a property you're working on at the moment. So let's explore these 3 now very quickly. Let's start off with mortgage and equity release calculator. So this one's pretty self-explanatory. You start off on the assumptions tab on the left-hand side. You put the date at which you want the calculation to start, the mortgage or the amount of money you're borrowing, the interest rate, the term, and then also, is this an interest-only mortgage? Are there any other repayments being made? And is this a part interest-only or part repayment mortgage, and what the interest-only amount is? And once you're finished, you can click on Save and Calculate, and then it works out the calculations. On the right-hand side, you can toggle between monthly repayments and annual repayments, but it will tell you the headline numbers at the top. That's the amount of money paid every month. There's the interest-only element of it. There's the total interest charges and the total cost of the mortgage over that entire term. And then line by line. So year 1, the beginning balance is 350,000. The payments total up to 31,000. That's because 17,000 is paying off the capital, 13 for the interest, and then the end balance is 332 year on year until we reach a 0 balance. Now, in terms of equity release, it's quite simple. You can just simply roll up the interest, save and calculate, and that changes it to essentially an equity release calculation where we can see that the beginning balance is 350. Essentially, nothing is being repaid back. It's just the interest accumulating on that debt. So 350 add the 14 equals the end balance for year one of 364, and then just rolls out that interest every single year, adds it to the outstanding balance up to 637 by the 15th year of that contract. But again, you can toggle between monthly and annual repayments. The stamp duty calculator is even simpler. So on the left-hand side, again, start off with the assumptions. What's the house price purchase? Obviously, the tax rates that will be applied will be dependent on whether this is a first-time purchase, if it's an additional residential property purchase, and whether you want to use Scottish rates and Welsh tax rates instead of English tax rates. But when you've made your decisions, click on Save and Calculate. On the right-hand side, it then calculates the total stamp duty payable based on the calculation methodology underneath. As with all of our tools and calculators, you can just click on Create Report to then generate a report branded with your logo. And finally, our rental yield calculator. So on the left-hand side, as always, we start off with assumptions. We're going to call this second home. Assumed growth rate, we're going to assume it's going to grow at 4% based on historical averages. The asset value today is about 500,000. Assumed inflation rate, we're going to expect 2.5% a year. So the real return of that asset is going to be 1.5. We're going to run this over 20 years, and we expect to receive a rental income of about 3.5% every year. So we can lock that in, save and calculate. And then what are the expected expenses that will be incurred over that 20-year period? We've got a new bathroom coming in. That's expected to be about 5,000, yearly maintenance of 6,000, new kitchen going in at 15,000, stamp duty and legal costs. And when you click on add an expense, you've got the description, what the annual amount is, and you can decide whether that's yearly or one-off. And obviously, depending on which one that is, you can then put the start date and end date, or if it's a one-off, just simply the start date, and then do you want to adjust that for inflation? But once you've locked all of that in, if you scroll down, you get a nice chart that shows the asset growth and the yield growth as well. So the blue bar is the house, starting at 500,000, running all the way 20 years. And then the rental yield coming into your basically your current account, your cash account, growing every year, obviously minus the expenses, up to about 251 at the start of that 20th year. And scrolling down from that, you've then got the facts and figures and the maths. So start off at 500,000, the asset, the total income, the 3.5% income yield is going to be 17,500 minus the total expenditure. You'll get 11,500 ending in the cash account at year end, and then the asset value at year end will be 507 and running all the way down year on year until the end of the 20th year forecast, which would be a cash value of 268 and an asset value of 673.